Very good day, students. In this video, we will understand the tax treatment of employer's contribution and interest on employer's contribution in case of provident fund. So let's look at the summary first. Let's look at this table. So we have statutory provident fund, which is a provident fund basically in which the government employees contribute, and then there is a recognized provident fund, which is a fund which is applicable across the private sector. And then there is unrecognized provident fund, which is not recognized under the Income Tax Act. And then there is PPF. PPF has got nothing to do with salary income, but it is still there in this table, which I have kept here for completeness purpose, for the sake of completeness. Now, as far as employer's contribution, there will be a contribution that will be made by the employer in the provident fund account of the employee. And then there will be interest which will be credited in respect of that employer's contribution. Now, when we look at statutory provident fund, the employer's contribution is exempt and there is no limit as such which has been specified. What about interest credited on employer's contribution? It is also exempt and there is no limit as such which has been specified. Now, when we come to the recognized provident fund, there are certain limits which are applicable. Why? Because see, statutory provident fund is generally meant for government employees. So since it is the case of the statutory provident fund which is maintained by the government as such, there is no need of so there will not be a case where the provisions will be misused to claim excessive exemption, right? Because things will move as per the limits in their own way. So there is no need basically to set up the limits. But limits are required when things are in the hands of the private sector, and therefore limits in order to prevent any misuse of exemption provisions need to be specified. So this is what we find in the case of RPF. Now, as far as employer's contribution is concerned, there is a limit up to which employer can make contribution which will remain exempt, and that is up to 12% of salary. And for this purpose, salary means what? It means basic plus DAT. DAT means DNS allowance where terms of employment so provide. That means where DNS allowance forms part of salary for computing retirement benefits as per the terms of employment. And then commission, CTO. TO means where commission is based on a fixed percentage of turnover, not being an absolute fixed amount every month, but commission based on a fixed percentage of turnover. So we compute salary as per this formula, and then we apply 12%, and that is the limit. So if the employer contributes more than 12%, the excess becomes taxable, and if the contribution is up to 12%, then everything remains exempt. Nothing becomes taxable under the head salaries. So this is the first layer as far as the employer's contribution is concerned. Okay. Now there is the second layer as well. The second layer takes into consideration the combined contribution of the employer to recognized provident fund RPF, approved superannuation fund ASF, and national pension scheme NPS. So employer can contribute to the account of the employee in the RPF, ASF, and NPS. So we need to see whether the employer is contributing, what is the amount that the employer is contributing to one or more of these. Okay, and the limit that the government has set is 7.5 lakh. Okay. Beyond this, the excess contribution becomes taxable. So if the employer is contributing 7.5 lakh combined for RPF, ASF, and NPS, and to the RPF it is up to 12% of salary, then nothing is taxable. If in the RPF the contribution is more than 12% of salary, under the first layer, the excess beyond 12% becomes taxable. Under the second layer, if the combined contribution for RPF, ASF, and NPS is more than 7.5 lakh, then that excess, if say the contribution is 8 lakh, then excess is 50,000. 50,000 will become taxable. It will be added to the income under the head salaries straight away. So this is the first layer, this is the second layer, and both the layers you need to take into account, you need to make a note of. Now, what about interest which is credited on employer's contribution? Now here also there are two layers. While for SPF there is no limit as such, because it is generally understood that SPF will work or the provisions will apply, the interest will be paid within the limits which the government feels are reasonable. So there is no need of any limits to be specified in the law itself. But as far as RPF is concerned, since it's it's something which applies to the private sector as a whole. So limits are to be prescribed to prevent a misuse of exemption. So interest will be exempt up to 9.5%. Okay, the government doesn't want people, employers to pay unreasonable amounts of interest, and all that interest will then be claimed as exempt at the cost of tax revenues of the government. So the government doesn't want that. So that's why a reasonable limit of 9.5%. In practically all the scenarios, you will find that the employee's contribution will remain within the limit of 12%, and interest credited will also remain within the limit of 9.5%. So as far as interest is concerned, this is the first layer, and there is again the second layer. The second layer is basically linked to the second layer for employees' contribution, where RPF plus ASF plus NPS combined contribution exceeding 7.5 lakh is taxable. Now that excess, okay, exceeding 7.5 lakh, interest relating to that excess, that becomes taxable here. Okay, so employees' contribution, RPF contribution exceeding 12% of salary becomes taxable, first layer. Second layer, combined RPF, ASF, NPS contribution more than 7.5 lakh becomes taxable. As far as interest is concerned, first layer, interest exceeding 9.5%, that excess becomes taxable. Second layer is interest relating to this excess contribution. Second layer, this becomes taxable, right? Now, as far as unrecognized provident fund UPF is concerned, employer's contribution remains completely exempt, and interest credited on employee's contribution remains completely exempt throughout the period of UPF. But taxability arises when there is lump sum payment of accumulated balance. In that case, the employer's contribution entire and interest thereon entire, the full amount, becomes taxable under the head salaries. Becomes taxable under the head salaries. So in the case of UPF, during employment, things remain exempt. But at the time of lump sum payment of accumulated balance, employee's contribution and interest thereon becomes taxable under the head salaries. Now, as far as PPF is concerned, basically it's not related to employer-employee relationship as such. So employer doesn't contribute. So employer's contribution and interest thereon, this is a point which is not relevant in the case of PPF. So basically what we will further note in this video is how this basically works. The combined contribution exceeding 7.5 lakh and interest thereon, how it is computed and how this works. The rest of the things are pretty easy and they're pretty clear. So let's move ahead with this video. So this is the approved superannuation fund, and as you can see, during employment, employer's contribution, the combined contribution of RPF, ASF, NPS more than 7.5 lakh is taxable. And as far as interest credited on employee's contribution is concerned, interest related to this excess, okay, this excess also becomes taxable. Now there is no independent limit as such for taxability of employee's contribution to ASF, approved superannuation fund. Just as for RPF, for employee's contribution there was an independent limit, which was what, 12% of salary, right? For ASF there is no independent limit in terms of percentage or in terms of an absolute amount per se, but only limit is that this combined contribution RPF, ASF, and NPS should not be more than 7.5 lakh. If it is more, then the excess will become taxable and interest thereon will also become taxable. Okay. Similarly, national pension scheme. Employees' contribution. So employees' contribution, the entire contribution is first included under the head salaries. So it becomes part of the head salaries. Okay. And thereafter, when we arrive at the stage of computing gross total income, and then we are giving deductions on the gross total income under chapter VIA, then there is section 80 CCD. Under section 80 CCD, we can provide the deduction from the gross total income in terms of employees' contribution as computed under that section. Okay, so this is number one. So many a times I have seen students, they don't add employees' contribution to NPS under the head salaries. This is the mistake that they do. So you must add the full contribution under the head salaries, and then you should provide 80 CCD deduction from the gross total income. And then the second layer, which applies same for RPF and ASF, that is the combined contribution of employer to RPF, ASF, and NPS till 7.5 lakh, it is not taxable. Whatever amount goes beyond 7.5 lakh, it becomes taxable. Okay. Now the accretion to the employer's contribution, and then there will be accretion in the NPS account in the balance. So it is exempt in terms of section 1044, and details are given in the section on section 80CCD in TaxBook Plus. This is beyond the scope of our discussion, so we are not going to discuss this. This accretion related to this excess becomes taxable. It is not exempt. So this is the same position for RPF, ASF and NPS. The combined contribution of employer beyond 7.5 lakh becomes taxable, and the interest related to that excess also becomes taxable. So this is what we need to check in terms of contribution of employer to the RPF, ASF and NPS accounts of the employee. Okay. So now we come to the point where we will discuss about the combined upper limit for employers' contribution to RPF, ASF and NPS more than exceeding 7.5 lakh, and how to compute the amount which is taxable. This will be provided, and this is provided under Rule 3B, and this excess and the interest related to excess, as we discussed, is taxable, and it is taxable as perquisite. Okay. So what we noted above is employer's contribution to RPF is exempt up to 12% of salary, but in excess of 12% of salary, it is taxable. This is the first layer. Second layer, if the combined contribution of RPF to RPF, of the employer to RPF, ASF and NPS exceeds the limit of 7.5 lakh, the excess is also taxable, and the accretion related to that excess also becomes taxable. This is explained below. Now look at this table. Employer's contribution to RPF plus ASF plus NPF in excess of 7.5 lakh in a previous year, the excess is taxable as perquisite under section 17.2.7. Under section 17.2.7. So this excess is taxable. And what is the logic? So some time back, this limit was not applicable. Okay, and it basically resulted in inequity between high salaried employees, high net worth employees, and low salaried employees, because high net worth employees, they were earning a lot of money, and they were able to design their salary structure in a way that they were contributing a large amount of salaries to RPF, to ASF, and to NPS as well. Okay, and they were claiming exemption in respect of interest and in respect of the withdrawals, lump sum withdrawals. And this was very unjustified because they were claiming tax exemption at the cost of the tax revenues of the government, at the cost of the exchequer. So the government felt that this is not really right, because the tax exemptions or incentives are not meant to benefit only the high net worth individuals. Okay, so they said that okay, we will put a limit, because we want to restrict the exemptions only to a reasonable extent, so that the masses are able to benefit from the exemptions, not merely a few high net worth individuals. So they said that okay, we will put a limit of 7.5 lakh. We will put a limit of 7.5 lakh. So excess beyond 7.5 lakh will become taxable. So if the combined contribution of employer to RPF, ASF and NPF is say 8,50,000 will become taxable. 50,000 will become taxable. And accretion on such excess will also become taxable. That will also be taxable. So annual accretion relating to the above stated excess contribution is taxable as perquisite, and it is taxable. It is computed in the prescribed manner. Now a few very important points. Note that in addition to the limit of 7.5 lakh referred above, there is a sublimit for employees' contribution to RPF, 12% of salary. This is what we have discussed. So in RPF, there are two layers, 12% and the 7.5 lakh. One in terms of percentage, 12%, and one in terms of absolute amount, 7.5 lakh. But there is no such sublimit for ASF. For ASF, the employer can contribute as much as he likes. But beyond 7.5 lakh, for RPF, ASF and NPF, it will start become taxable here. Okay, but there is no specific sublimit as such for ASF. Okay, and as far as NPS, we have already noted some time back that entire employee's contribution is first included in the salary income and then deduction under section 80CCD is provided. So you need to take care of all these important points. For employee's contribution, RPF, first layer 12% of salary. Note this. Second layer, combined RPF, ASF and NPS more than 7.5 lakh becomes taxable, and accretion thereon also becomes taxable as computed under Rule 3B. Okay. For ASF, there is no as such a separate independent sub-limit for employees' contribution to ASF, but the combined ASF, NPS and RPF beyond 7.5 lakh becomes taxable. For NPS, the whole of employees' contribution, you need to add it to the salary income and then give deduction from the gross total income under section 80CCD. Further, combined ASF, RPF, NPS more than 7.5 lakh excess is taxable. So this provision becomes relevant in all the cases. Right? Next point. This provision is applicable only for excess contribution of employer and related interest. We are not talking about employer's contribution and related interest. There is a separate video which I have created on this. Okay, there is a separate video explaining the taxability of employees' interest. If you look at this table, as far as employees' contribution is concerned, 80C can be claimed. Okay, so excess employees' contribution, the excess is not taxable, but interest related to excess employees' contribution is taxable. So as far as employees' contribution is concerned, 80C can be claimed. And then as far as interest credited on employees' contribution is concerned for RPF, there is one layer where up to 9.5% it is exempt. And in the second layer, interest related to a contribution up to a certain limit is exempt, but interest related to excess contribution becomes taxable. And that limit is in that video, as we discussed, it is basically 2.5 lakh or 5 lakh as the case may be. So in this video, we are not talking about employees' contribution and interest thereon. We are talking about employer's contribution and interest thereon. Okay. Excess employer's contribution is taxable in the previous year in which it exceeds the limit of 7.5 lakh. Okay. So, say in previous year 1, say it is 8 lakh, so 50,000 will become taxable. In previous year 2, it becomes 9 lakh, so 1.5 lakh will be taxable. In previous year 3, it becomes 10 lakh, so 2.5 lakh will be taxable because it is excess of 7.5 lakh. But as far as accretion, in case of RPF, for example, if it is interest which is getting credited on this excess, 50,000, 1.5 lakh and 2.5 lakh respectively, this interest will keep on getting taxed because this interest is on excess. Now this interest on 50,000 will become taxable, okay, and then this interest will get added to the balance, and then there will be interest on that interest. Now that interest will also become taxable, and then again the interest will keep growing and the interest will again become taxable. So on this excess, the interest and then interest on interest and then interest on interest on interest, interest keeps growing, and the interest or the accretion, whatever the case may be, keeps getting taxable, okay, across the various previous years. But as far as excess beyond 7.5 lakh is concerned, it is only related to a particular previous year in which there is excess. So only for that year that excess of beyond 7.5 lakh becomes taxable. Okay, this should be clear. Now the computation of taxable accretion. How do we compute taxable accretion? This is provided under Rule 3B. Under Rule 3B, and this mechanism needs to be clear to us. Question may be asked in the exam to compute the amount of taxable accretion. Okay. Now, these are the steps, and there are 3 steps basically, 1, 2, 3, and particulars for RPF plus ASF plus NPF plus NPS, because the combined amount or the aggregate is what needs to be seen. And what we basically do in step 1, we compute certain amounts for a particular period. Similarly for step 2, and in step 3 we compute the amount of taxable accretion. So the whole period in terms of contribution we segregate into 2 parts. One part falls under step 1, the other part falls under step 2. In step 1 we consider the period from previous year 2021, this is the previous year from which this particular provision became applicable. So period from previous year 2021 to the previous year preceding the current previous year. Okay, so say if the current previous year is what? It is say 24-25. Previous year 24-25. For example, if this is the current previous year, so in step 1 we will take into account the period from previous year 2021 to previous year 23-24, 2021, 21-22, 22-23 and 23-24, 4 previous years. Okay, and in the second step we will take the period which is the current previous year 24-25. So in step 1 we take the period from previous year 2020 21 to 2023-24 and we compute two things. One is aggregate of taxable employers' contribution to the fund or the scheme for each previous year. Okay, so for these 4 previous years, for each previous year we find out whether the employer's contribution to RPF, ASF and NPS, okay, was more than 7.5 lakh. So we pick up the excess for each year and then we aggregate, we total that excess and that becomes PC1. Okay, so if it is say 8 lakh in all these 4 years, so 50,000 is the excess beyond 7.5 lakh in each of these 4 years. So 50,000, 50,000, 50,000, 50,000. So PC1 will become what? It will become 2 lakh. Okay. 1.2 step, we find out the taxable accretion for each of these previous years. Okay, computed as per rule 3B. So for each of those 4 previous years, rule 3B would have applied and we would have arrived at the amount of taxable accretion. So we total the taxable accretion for all those 4 previous years and that becomes TP1. Okay, so we arrive at PC1 and then we arrive at TP1. This is under step 1 for this particular period, previous year 2021 to the previous year preceding the current previous year. In step 2, we only look at the current previous year. First, 2.1, what we find out? We find out the taxable employees' contribution, which is in excess of 7.5 lakh. Say this year also it is 8 lakh, so 50,000 becomes the excess and that is what we call PC. Okay. Second, we find out the income accrued in the fund or the scheme. The interest or dividend, etc., whatever be the accretion, whatever is the income which is accrued in the fund or the scheme, we find out and this is what we call as I. In the next step, we find out the average balance. Okay, we take the balance in the fund or the scheme on 1st April of the previous year, the opening balance, and the closing balance, that means balance on 31st March, and then we divide it by 2, and this is what we call as the FAVG, average balance. In 2.4, we find out the return, and the return is what? It is I divided by FAVG. I means the income that has accrued divided by the average balance. That gives us the rate of return or the return. This is what we call as R. Okay, so we basically arrive at these figures. And then in step 3, we figure out or compute the amount of taxable accretion. So this is the formula. So we apply this particular amount by R, which is the return. So we apply this amount by return and this is when we get taxable accretion amount. Okay, and what is this amount? We basically add 2 things. In respect of step 1, okay, we add PC1 and TP1. We add both these, PC1 plus TP1. This is one amount that we get. For the current year, we take PC divided by 2. Okay, PC divided by 2. This is the second amount that we get. We add both. We add both and then we multiply the aggregate by R. And this is the amount which will be taxable in the current previous year under rule 3B, the amount of taxable accretion. So in the current year, what will be taxable? The employee's contribution which exceeds 7.5 lakh, that is the absolute amount that will become taxable. And what will become taxable is this amount, taxable accretion under rule 3B. So we take PC1 plus TP1, okay, and then we take PC divided by 2, we total both, and then we multiply the total by R. Okay, now this is a star. PC1 plus TP1. Now this PC1 plus TP1, okay, this is basically what? This is the aggregate of the taxable employees contribution exceeding 7.5 lakh and the aggregate of taxable accretion for each previous year for the previous year preceding the current previous year, starting from previous year 2021. Okay, this is what we aggregate and this is what we call PC1 plus TP1. Now this cannot exceed the opening balance. This cannot exceed the opening balance. Opening balance? Balance in the fund or the scheme as on 1st April of the current previous year. Any excess should be ignored. Okay, so this PC1 and TP1, if you visualize, this is what? This is basically the excess and the interest on excess for all the earlier previous years, right? The excess and the taxable amount. That means the excess beyond 7.5 lakh and the interest thereon, which is also taxable. This is what is PC1 plus TP1 for all the earlier previous year, which is earlier to the current previous year. This is PC1 plus TP1. Now, PC1 plus TP1 needs to be taken into account. But what if the opening balance falls below PC1 plus TP1? Say a lot of amount has been withdrawn and therefore the opening balance, it falls below PC1 plus TP1. So for computing the taxable accretion, should we take the opening balance into consideration or should we take the higher amount, which is PC1 plus TP1, into consideration, where a large part of this PC1 plus TP1 is actually not in the balance because the opening balance is less than PC1 plus TP1. So common sense says what? Common sense says that we should now take the opening balance only because opening balance is even lesser than PC1 and TP1. So what we need to always check is what is the opening balance as on 1st April of the previous year. If it is less than PC1 plus TP1, then this PC1 plus TP1 will be the opening balance. It will not be PC1 plus TP1. This is what we need to keep in mind. So this is how we compute the amount of taxable accretion. Now let's look at an illustration, an example. Suyash joined Z Limited as the marketing head with effect from 1st April 2023. This was his first employment. During the previous year 24-25, okay, Suyash contributed 8 lakh to his recognized provident fund RPF account. Z Limited made a matching contribution, that means of 8 lakh. And this amounts to 12% of salary. Okay. Now balance in his fund account, RPF account, as on 1st April 24 was rupees 17 lakh. And interest accrued during the year 24-25 was 2,50,000. Compute the taxable perquisite in the hands of Suyash for assessment year 25-26. Contribution during the previous year 23-24 was of the same amount, that means 8 lakh. And the taxable accretion under section this is rule 3B for that year was computed at rupees 2,200. See, Suyash joined 1st April 23, previous year 23-24. Okay. But we are asked to compute the taxable amounts for previous year 24-25. What happened for 23-24? For 23-24 also, rule 3B would have been applied and taxable accretion would have been found out, and that is given in the question itself that it was rupees 2,200 under rule 3B. And now we are asked to compute the amount of taxable annual accretion for assessment year 25-26, that means previous year 24-25. Okay. So steps 1, 2 and 3. And particulars for RPF plus ASF plus NPS. Here in our example, there is only RPF, so we will only consider RPF. So step 1, we need to compute the following amounts for which period? For the period from the previous year 2021 to the previous year preceding the current previous year. Okay, that means from previous year 2021 to previous year 23-24. Okay, here, since Suyash was employed only from 1st April 2023, that means this period will only be previous year 23-24, only one previous year will fall under this particular period. And for this period, what we need to compute? Aggregate of taxable employees contribution, that is exceeding 7.5 lakh for each of the previous year comprised in this period. Here it is only previous year 23-24. And the excess will be what? Excess over 7.5 lakh. 8 lakh is the contribution, so 8 lakh minus 7.5 lakh will be 50,000. Now in this computation, we only need to consider employer's contribution, not the employee's contribution, because we are computing taxability in respect of excess employer's contribution only. So aggregate of taxable employer's contribution, not employee's contribution. Secondly, we need to aggregate the taxable accretion computed under Rule 3B for each of the previous years. Since there is only previous year 23-24 in this case, and in the question itself, the amount computed under Rule 3B is given at 2,200. This becomes 2,200. So PC1 becomes 50,000, TP1 becomes 2,200. Clear? If it is more than one previous year which is comprised in this particular period, then we will aggregate the amounts, and the aggregate is what we will mention here. In step 2, we need to consider the current previous year, which is what? Previous year 24-25. And here in step 1, what we need to find out? We need to find out the amount of taxable employees contribution more than 7.5 lakh, and contribution is 8 lakh, so the excess becomes 50,000. This is what we call as PC. Next, we need to figure out the income accrued during the year, and it is given in the question itself. Interest accrued during the year was 2,50,000. So 2,50,000 is taken here, and this is what we call I. Average balance. In step 3, we need to find average balance. Balance opening and balance closing divided by 2. So balance in the fund scheme on 1st April, balance on 31st March divided by 2. Okay. So balance on 1st April of previous year, 1st April 2024 is 17 lakh. So 17 lakh is already given here. So this is 70 lakh. This is opening. What is closing balance? It is not given on 31st March 23-25. So we need to compute. It will be what? It will be 17 lakh opening balance. Okay. Then what will be added to the balance? The contribution made by both Suesh and Z Limited of 8 lakh each. So 16 lakh will be added. Okay. Here we are talking about the balance in the fund, and the balance in the fund will include both employer and employee's contribution, the balance in the fund. Here it is taxable employer's contribution. Here it is taxable accretion. Okay. Here it is taxable employer's contribution. But here we are, here it is income accrued in the fund as such, and here it is the balance in the fund as such. Okay. So opening balance 17 lakh plus 16 lakh contributions, and income accrued, it is 2,50,000. It is given in the question. So this will be the closing balance. So closing balance will be 35 lakh 50,000. So opening plus closing divided by 2, this will be average balance 26 lakh 25,000. We call it FAVG. Next, we find out return. It is I divided by FAVG, I divided by FAVG, and it is 0.0952. Okay. Since it will be mostly figure in decimals, to ensure the accuracy in the amount of taxable accretion that we compute, it will be useful if you can figure out this R to 4 or 5 decimal places. The more you do, the more accurate the amount becomes. So I think to 4 decimal places will be good enough. And lastly, we'll figure out taxable accretion. And as we noted in the formula, we need to multiply a particular amount by R. Okay. And what is this particular amount? For step 1, we need to take PC1 plus TP1, PC1 plus TP1. This is 50,000 plus 2 lakh, 2,200. 50,000 plus 2,200. So 52,200. Next is PC divided by 2. PC 50,000 divided by 2. This is 25,000. So this and this we need to add, and we need to multiply it by R. R is what? 0.0952 multiplied by R. So this is what will be the formula, and ultimately we will get this amount 7349. This will be the taxable accretion under Rule 3B for AY 25-26. So what will be the taxable perquisite for AY 25-26? 1. It will be 50,000 rupees. Being employees' contribution in excess of 7,50,000, 8 lakh is the contribution, so excess is 50,000. This 50,000 will become taxable, plus the accretion on the excess will become taxable as computed under Rule 3B, which is what? Which is 7349. So 50,000 plus 7349 will be 57,349, which will be taxable as perquisite under the head salaries. This is for employer's contribution. So we saw the taxability regarding the employer's contribution. But we also should not forget about checking the taxability of employees' contribution. Though this is not the subject of this video, but in the example, there are tax implications which are coming out for employees' contribution. There is a separate video that I have made on this, and you can check out that video. But what we need to know is for employees' contribution, there is a limit, okay, which applies from previous year 21-22. And if the employee contributes more than this limit, 2.5 lakh or 5 lakh as the case may be, if both employee and employer contribute, which is the case in our example, then the limit is 2.5 lakh. So if the employee is contributing more than 2.5 lakh, then interest relating to that excess, okay, becomes taxable. It is not exempt. So this is the case which is arising in our example, So Suyash joined 1st April 2023, so we have previous year 23-24 and current previous year 24-25. So we have 2 years, and in both the years Suyash contributed 8 lakh, his own contribution, and this is more than rupees 2,50,000. So 5,50,000 is the excess. So interest relating to this excess will become taxable in the current previous year. So interest on all these will become taxable. So interest on the aggregate of all these 1, 2, 3 will become taxable in the current previous year. And what are these amounts? So in previous year 23-24, the first previous year Suyash excess contribution was 5,50,000. Okay. And for the current previous year also the excess is 5,50,000. And in the previous year 23-24, the first previous year interest would have accrued on this amount, and that interest is now added to the balance. So now interest on that interest as well. Okay. So interest on the aggregate of 1, 2, 3 will be what will be taxable under the current previous year as well. So this is also what we always need to check in our question. So both the tax implications on account of excess employer's contribution as well as the tax implications on account of excess employee's contribution. There is this question which you should solve. If there is any doubt or difficulty or any question that you have, just write in the comment box, or if you have my WhatsApp or Telegram number, just call me up or write to me directly. I'll respond to you as soon as possible. Hope this concept was clear to you. See you very soon in my next video. All the best to you. My good wishes. Good luck. Goodbye.